Gold has played a major role in the history of civilizations around the world and their advancements. For thousands of years, it has been used as a universally accepted currency and also a symbol of wealth. Wars have been fought over it and civilizations destroyed. But the value of gold has been non-stop compounding for over 5,000 years and it is still going strong. So today we will try to understand gold as an investment through the demand and supply equation, because that's what affects the prices and our investments. And we will also talk about two big blunders which investors are making while investing in gold. So let's go. Namaste and welcome to Retail Investing. So before we get into the demand-supply equation, let's understand the very nature of this asset class. It is called a commodity. What exactly is a commodity? Let's say you buy some gold from Hyderabad and then you go to Dubai and buy some more gold there. Now the two purchases will be indistinguishable from each other. In this sense, a commodity is the exact opposite of a product. So we have two products, an iPhone and a Samsung Galaxy Ultra. Both are smartphones, but users can differentiate between them in an instant and people will be willing to pay different prices for them. So as a commodity, gold is a bit different from other commodities like wheat and crude oil, which are consumed. So crude oil is converted into petrol. In some countries, it is called gasoline. Sounds really cool. And then it is used in our vehicles. And wheat is turned into flour. And then it can be used to make naan, which I personally like a lot. But the case with gold is a bit different. Gold is permanent. Due to its chemical composition, it cannot be used up. So theoretically, this can mess up the demand and supply equation. You see, the demand for commodities like crude oil and wheat is not optional. We need them to survive, but gold's demand is mostly optional. Now in reality, this has not affected the demand for gold yet, but retail investors should imagine all kinds of possible risks before investing. So let's talk a little bit about the supply part. China, Russia, Australia, Canada, and America. These countries do the most of the world's gold mining. And in terms of volumes, mining of gold has not changed much since 2016. The theory is that all the gold which could be easily mined has already been taken out. Now miners have to dig deeper to get access to the gold reserves. In short, it costs more to produce the same amount of gold now. So this can bring down the supply and increase the prices. That's good news for investors who are holding it for a long time. So gold has always had both a real value and a perceived value. Perception is often more powerful than reality. In people's perception, gold has been a symbol of power and wealth for thousands of years.
ये देख रही है, ये देख, असली असली 50 तोला कितना 50 तोला.
Now the power projection is usually done in a more subtle way, but you can get the picture. And data from the World Gold Council says that in the first half of 2022, jewelry demand was 44% of all gold demand. Among the largest consumers of gold jewelry, India is a special case. Wearing gold ornaments for important ceremonies is essential in Hindu and Jain cultures. Buying gold during festivals like Diwali is a tradition, and weddings generate almost 50% of India's annual gold demand. No wonder the Titan stock is one of the biggest multi-baggers in history. It has created billionaires out of apparently broke people. So the Reserve Bank, if we try to find out what assets they have, it's primarily two assets: currency reserves, both Indian currency and foreign exchange, and gold reserves. Central banks all around the world have gold reserves, especially since the 1970s. You see, in 1971, the gold standard was abandoned, meaning the world's reserve currency was no more measured against gold, and it could not be exchanged for gold. Since then, central banks around the world started buying more and more gold because trust in the US dollar took a little hit. So in times of uncertainties, economic uncertainty and political uncertainty, by the way, most of the time, one is the cause for the other. Whether it is a recession or a war, a pandemic or a minority government, gold has provided protection against bad times if held for the right duration. So central banks are likely to buy more gold during such times, increasing the overall demand and the prices. So like all commodities, gold is also priced in the world's reserve currency, which is the US dollar. And the price of gold is related to the value of the US dollar. When the dollar gets stronger, the price of gold usually comes down. That's because investors put their money in dollar assets. And when the dollar gets weaker, the demand for gold goes up, and for the same reason, gold prices go up. So for this reason, gold is believed to act as a hedge against inflation. From 2022, we have some data which shows that this reverse correlation did not work. But historically, gold has worked during most bad times. Now the CEO of Quant Mutual Fund has something very interesting to say. According to him, the commodity cycle has bottomed out, including precious metals. Their quantitative algorithm has been very successful in the past in predicting various sectoral cycles. And if they are right again, then it's a very good time to invest in gold. So in between wealth creating assets and wealth protecting assets, gold falls somewhere in between. It's far better than a fixed deposit, but not as good as stock investing over long periods, considering you can pick the right stocks. Sovereign gold bonds is a very good option. There are a lot of videos on YouTube. You can watch them and I have nothing to add. The second best option in my opinion is a gold ETF. Like the Nippon Gold Bees, it's traded like a stock and you need to have a demat account to invest in it. And there are no making charges or GST involved, as is the case with physical gold. So you definitely want to avoid physical gold as an investment. Now let's talk about the blunders which some retail investors are making while investing in gold. So stocks of some gold companies get heavily promoted on social media. Often they go to zero, so you need to avoid them. And also understand that buying such a stock will make you invest in a gold mining business, not in the real gold. So if you get into gold derivatives, you can make money even when gold prices are falling. If anybody tells you something like that, please run away.